Hello, my name is Evan Morrison, and today I will be doing my case analysis from Chapter 2, which is the cash flows at East Coast Yachts. So for a quick little overview about what I'm going to be talking about today, first I'll introduce you guys to the case itself, give you a little bit of the relevant information. Then I'll get into the description of East Coast Yachts cash flows. After that, I will look at the most accurate statement of cash flows, so what most easily interprets their cash flows. Then lastly, I'll give you my thoughts on expansion of the company. So for introduction, East Coast Yachts recently just incorporated as a company, and they also just became a publicly traded company. Their owner, Larissa, decided to do that just recently over the past year, so this is kind of where they're at right now. They just hired a consultant for their short-term financial planning. They underwent a lot of rapid growth to where they were a little bit unprepared for how to exactly handle that. So they went out and hired Dan Irvin, who is here to now kind of help with the short-term financial plans for the company itself and help give it a little bit more direction. So, to answer the first question that was posed in the book, which is the description of currently how their cash flows is going for East Coast Yachts. So here I actually made a statement of cash flows using the indirect method for East Coast Yachts. And as you can see, they have impressive cash flows. Like, that's something that they do not lack in, is generating revenue, essentially. As you can see, their net cash flows, hopefully you can see this. At the beginning of the period, beginning in 2019 and 2020, the started at 9.5 million, and then at the end of the period, it went up to 10.5 or 10.1 million rather. So generating revenues and creating cash from that revenue is something that's a positive for East Coast Yachts. Their gross profit margins also tend to be really good. They during this period, they were at a 28% rate for gross profit margins, and then down to an 8% rate for their net profits margins. A note that I have from their cash flows is the questionable decision making, and I base that off of if you look at their cash flows from financing activities, they have some interesting things that happened. So they issued about $36 million of new long-term debt, but directly after that, they then retired about $20.3 million in long-term debt. So I'm not sure exactly what the thought process was there and kind of what they were thinking behind that. The only thing I could think of was maybe if they wanted to refinance at a better interest rate or something like that, then that could maybe make sense as to the new issuance and then the retirement of the long-term debt. But that's the question that I would have going into, or just by looking at their statement of cash flows. The next thing was the issuance of stock. So they repurchased about $32 million of stock, and directly after that, they then reissued about $21.8 million of stock. So again, the thought process behind that wasn't quite clear to me. The book doesn't say anything, the case doesn't say anything about that, so I'm not quite sure what they were thinking there. Just kind of the overall perception of it didn't make a whole lot of sense to me. The last thing that stood out to me was their dividends. They paid out almost $20 million in dividends over this time period, and that is about 30% of their, if you look at their net cash from operations at $62 million, that ends up being about 30% of their overall net operating cash. So that's a big number. I don't know why they would pay that much out to their shareholders. It didn't make a whole lot of sense to me either. So that'd be another question I would have for the CEO and CFO of East Coast Yachts, and to kind of see what their whole thought process was there. Then I'll answer number 2 from the book, which was what I think the most accurate business or financial statement was from the case. and they gave the income statement and they gave the balance sheet, both of which are important and I think were both helpful. However, I think that it's kind of a third option. I would say the statement of cash flows ends up being the most, the best way, in my opinion, to kind of see their strategic direction as far as finances are concerned. So that's why I went ahead and, as you can see on the previous one, I went ahead and made a statement of cash flows using the indirect method, because I feel like that gives you the most clear-cut view of how they're doing financially and kind of what directions they're going in and what things you can pick up from the cash flows. I think makes it the easiest. So as I say here, the statement of cash flows ranks king, so that's why I think that makes the most sense as far as figuring out the best financial statement to look at to give the best description. Now we're getting into my opinions of their expansion plans. Now, the case itself doesn't really tell you their expansion plans. It mentions that one of the owners, Larissa, is looking to expand, but they didn't exactly say what that looks like. But what I do have are some strengths and weaknesses, and then maybe some recommendations of how they can move going forward. So the first strength, I think, is just their ability to generate revenue. Like, obviously they're able to make money and also profit off that money based on their profit margins being 28% again gross profit margin, and then 8% as a net profit margin. So those are both strengths. Another thing is their working capital is adequate, being at a current ratio. If you go look at the balance statement, their current ratio is at a 1-to-1 ratio, which is adequate. It's where you want it to be. So that's a positive thing. The other thing is their cash liquidity. So as mentioned before, they're over this time period, they moved their cash liquidity from 9.5 million to 10.1 million, which again, the positive thing to be able to do that. Their weaknesses, I believe, is obviously their revenue and profitability are based on how the economy is. So if you go into an economic recession, or if financing, you're not able to get money as cheaply, then obviously that's going to be a weakness, and it's going to be an external weakness that they're going to have to be aware of, and also be ready to hopefully proactively adjust to, as opposed to reactively adjust to. The other thing is their direction. So I think just from reading their statements, it didn't make a lot of sense as far as where East Coast Yachts is looking to go. Again, I say that in regards to their debt and equity. Going back to the cash flow statement of them reissuing stocks and then rebuying stocks back to back, that didn't make a whole lot of sense. And the same thing with their long-term debt of go out and financing, and then also then paying off some previously loaned money. So that their direction didn't seem very clear to me, and that seemed like a weakness because they're not being as efficient as they could be, which leads to a waste of money. Then just a lack of direction as a whole is obviously not a great thing to have. And then lastly, their dividend situation of paying out $20 million in dividends, which ends up being 43% of their 43% of their net earnings and 31% of their operational cash flow, which is a rather large amount of dividends to pay out. And again, dividends can depend on their industry and how rapid it's growing and stuff like that, but just by and large, like, this seems like a very large amount of dividends to pay out. And the only reason you pay out dividends is if the business itself cannot use the money any better than the shareholders. And in this case, I think there are opportunities for the business to use that money in order to progress their business here. So my recommendation would be, first of all, a sturdy financial plan. I think that's what they're kind of leaning towards when they hired Dan as their financial consultant, and also just a business plan as a whole regarding where they want to go with the company, if they want to diversify, which I would recommend due to them being a pretty concentrated company right now. I think a business plan as a whole, and then also the financials of the business plan is going to be a huge thing for them. And lastly, I think specifically dropping their dividends payout ratio would be huge, because if you could drop it from 30% down to say 10%, that would give them about $13 million in cash to decide what to do with. And being that they're still lease or getting money or loaning money rather then it makes more sense for them to internally finance themselves as opposed to go out there and have to again reissue or buy I think it was what $20 million of new debt, or $32 million rather, sorry, excuse me, of new debt. So it seems like if they cut back the percentage and dividends, then they'll be able to internally finance themselves as opposed to having to go out and externally finance themselves, get themselves leveraged in a certain way that might not be optimal. So those are my recommendations. Let me know if you guys have any questions, and without that, then thanks and have a good night.